Today's Talk About It Tuesday question is it better to invest your money or put it into a high yield savings account? Okay, so good question. But better or worse is really relative, and there are certain factors that you have to consider when deciding better or worse. What are your goals? What is your risk tolerance? What is your level of knowledge and skills when it comes to investing? Um, how long do you have? What's your time horizon? So there are a lot of factors. What's the state of the economy currently? All these things are factors that will um, influence your decision as to which one you choose. Personally, I think you should always diversify and have money in both. But let's just talk about the advantages and disadvantages of each, and then you can decide which one to weigh more heavily currently as opposed to the other, um, as opposed to choosing one or the over the other forever. So high yield savings account. So what is the difference between a high yield savings account and a traditional savings account? And the difference is the amount of interest that you get. So currently, a traditional savings account, which most of you are accustomed to, where you go to the bank and just have a savings account, that national average is paying 0.33%. So that's about a third of 1% interest. So that means for every $100 that you have in the bank for a whole year, you will earn 33 cents. So it's not a big return. So there's not a great incentive if you're trying to make money to put it in a traditional account. So what's the difference between that and a high yield savings account? So high yield has a fluctuating return, a fluctuating interest that's based upon the the interest rates that are set by the Federal Reserve. So when you have a higher interest rate, it goes up, right? And so currently, you can get a high yield savings account that's paying between 4 and 5%, not a third of 1%, but between 4 and 5%. So that seems phenomenal. And in relation to a traditional savings account, it is phenomenal. Here's the situation. You could possibly get more because the interest rate fluctuates again with the current interest rates that's set by the Fed. So you could put the money in today at 4.5%, and it could go up to 6% if the interest rates continue to go up. But it could also go down to 1 or 2%. Now, no matter how low it goes, it's probably going to be a traditional savings account because those are fixed at an extremely low rate. But the danger is that it's possible that it doesn't beat the inflation rate, right? Because the current inflation rate, as I'm making this video, I believe is 4.04 this month, which is actually down. I think it was like 4.89 last month, and last year was 8, which was ridiculous. So even at 4.04, it's possible that you're not really making a profit. You could be breaking even, or if you have up to 5%, you're making a slight return on your money. And so why would you do that instead of investing? Well, investing, you could lose your money. In a savings account, you're definitely not going to lose the money, that your principal that you put in, because it's insured by the FDIC. Even if your bank fails, your money, your deposit is secured. So you don't have to worry about that. So there's much lower risk when you put it in a high yield. Currently, you're mitigating the effects of inflation because you're not going to lose. You're pretty much on par with where the inflation rate is. You have liquid access to your money, right? You can go take it out anytime that you want to, so it's very liquid. So those are some advantages. The disadvantage is if the market corrects itself, then it's going to go down, and you're probably not going to be able to beat inflation. So if you look at investing, if we look at the stock market, currently, year to date, the S&P 500 is not doing well. I think it's at 1.15% at the time of this video. So 1.15%, it's not beating the inflation rate. So If you had a choice in the moment, and you have a short-term goal, then the savings account obviously is performing better. But here's the difference too. If you're thinking long-term, the stock market goes up and down in waves over years and will probably net you in the long run a greater return that far exceeds the inflation rate, because in the long term, the S&P 500, which is Standard & Poor 500, top 500 companies in the stock market, averages 10%, right? So over the long term, if you left it there, you're definitely going to get a bigger return. You'll definitely be able to beat inflation. And if you just use the S&P 500 as your benchmark, then you don't need a lot of skills. You just do either an ETF that does the S&P 500 or an index fund, right? So if you just use that as your benchmark in the long term, then investing does better. So the real answer is one is not necessarily better than the other in the long term. I think if you have a bit of money in both, if you can, then you should do both, and you weight one more heavily than the other at different times when the economy is doing what it does. So in general, when the stock market is doing poorly, interest rates go up, high yield savings go up. When the stock market is doing well, interest rates go down, and high yield savings accounts they perform not as well as the S&P 500. So the trick is to keep it pretty steady, to have money in both at all times, and at certain times you'll weight one more heavily than the other. So love to hear your thoughts on that, what your strategies have been over the years. Please like, share, subscribe, keep the questions coming, and I'll see you next Tuesday.